Welcome again to another video. In this video, we're going to go over chapters 18 and 19, doing it a slightly different way. Gaining from international trade and international business. So, over the time, especially since the 60s, the growth of imports and exports has grown exponentially as a percent of GDP, but has been negative. Net exports have been negative until about 1995 was the only year that may have been positive, where we had a net export that was positive versus all other years. US is a net importer, which means we import more goods and services to the United States than we do exporting. Currently, our largest trading partner is China, with Canada and Mexico being close second and third. The reason why Canada and Mexico is our second and third largest trading partner currently is due to the NAFTA, North American Free Trade Agreement, which was in effect until 2018, where it was renegotiated. So, why would a country get involved in the international marketplace at all? Now, international trade is not done on the individual basis, on family or household basis, or business to business basis. It's done between governments. And so, because of that, you can't really use the nominal value of money to determine what is being exchanged between the two countries. It's based on product. So, it's a real value to the trade. Like other voluntary exchanges that we talked about, that's one of the 10 tenets. International trade occurs because both the buyers and sellers expect to gain something, and generally do. If they don't gain anything or don't expect, they wouldn't agree to an exchange. So buyers and sellers will sellers or suppliers in the marketplace will only supply when there is a marginal or a net benefit to that. So, what is the law of comparative advantage? A group of individuals, regions, or nations can produce a larger joint output if each specializes in the production of goods in which it is a low opportunity cost producer and trader trades for goods for which it is a high opportunity cost producer. What does that mean? That's a lot of mumbo jumbo, legalese, textbook. What it really means is that comparative advantage is where you would country would produce a product to sell when it has a lower opportunity cost than another country. If we look, for example, to the US and the manufacturing of cars, which we do a lot in Michigan, being the automotive capital of the world or of the country, Detroit, and we look at maybe a country like Thailand that produces a lot of rice. It's more difficult because we do not have the climate in the United States to actually grow rice to the level that we need beyond what we demand as a nation, as citizens of this nation, as people in this nation. But we can also make cars, and Thailand doesn't have the environment, the resources necessary to make cars to the level that the people and the citizens of Thailand want. So they have a higher opportunity cost to try to make a car versus the low opportunity cost of growing rice. Conversely, US has a high opportunity cost to grow rice, but they have a low opportunity cost to make cars. So the comparative advantage is that the US has a lower opportunity cost. It would take more rice in the United States to make a car than Thailand. And conversely, or on the other hand, there's higher opportunity cost for Thailand to make a car versus US. And that is more succinctly, hopefully more succinctly, the understanding of the comparative advantage. So let's look at a chart here. We're comparing food and clothing produced per worker per day in the US and in Japan. So in column one, we're looking at food, and in column two, we look at clothing. In the US, a worker can make in a day 2 units of food or 1 unit of clothing. And in Japan, a worker can make 3 units of food or 9 units of clothing. If we look at the advantage of the two between the two countries, Japan can make more food or make more clothes. So it has what's called an absolute advantage when we look at the comparison of food, which is more, and clothing, which is more. Japan has a higher number, both in food and clothing, so it has an absolute advantage. So why would Japan trade with the United States? Let's look at the opportunity cost. So in the opportunity cost, which country has the lower opportunity cost? Well, the opportunity cost for a unit of food in Japan is 3 units of clothing. In the US, the opportunity cost is half a unit of clothing. Thus, US comparatively has a lower opportunity cost when it comes to food. It can produce 1 unit of food for only a half unit of clothing, but it takes 3 units of clothing to make 1 unit of food in Japan. So it costs more clothes, the resources to make clothes versus producing food. So US has a lower opportunity cost when it comes to food production. What about when it comes to clothing? The opportunity cost of a unit of clothing for Japan is a third unit of food. In the US, the opportunity cost is 2 units of food. So Japan has a lower opportunity cost, therefore, it's a lower cost producer of clothing. Because of that, Japan can allocate more resources to making clothes, and the US can allocate more resources to making food, and the overproduction, the oversupply of food that the US has can trade that with Japan, and Japan can then trade clothes to the US. So there's the exchange to make up for the demand for the clothes and food in US and Japan. Now, we only looked at the supply side at this point. So looking here, you can see here that in the US, if the US moves three workers from clothing to food, it will produce 6 units of food, but it will be less clothes. If Japan moves one worker from clothes, it'll only make three fewer. I'm sorry, if it moves one worker from food to clothes, it's going to make 9 units of clothing. But no food. So by reallocating the labor to maximizing its potential, the US can then make 3 units of food while Japan can make 6 units, net units of clothing. And the additional units of food that the US doesn't need can be traded for the additional units of clothing that Japan doesn't need. So let's talk quickly about the production possibility of both countries as it relates to clothing and food only. In the US, based on that ratio, if they allocated all resources to making clothing, they can make 200 units. If they allocated all, or 200 million units, as you can see, it's in millions. If they allocated all resources to making food, they can make 400 million units of food, points M and N respectively. With Japan, if they allocated all resources to making clothes, they could make 450 million versus all resources to food is 150 million per day per labor. And we're basing that on 200 million people in the US labor force versus 50 million in the Japanese labor force. And in absence of trade, the consumption of possibility would be restricted to a point like this point right here. Or in Japan, this point right here. With specialization and trade expanding this consumption possibility. If US trades food for clothing, then it can specialize in producing food and consume on the blue line here on the top, the where points O and N meet. And if Japan trades clothing for food on a one-to-one basis, it can specialize in the production of clothing and consume any combination on this new blue line on the bottom here, which is RT, rather than the original magenta lines that we had before on the production possibility. So both countries are better off because they meet at a new line and a new point on that new line right here and here, which is equivalent to, in the US, 200 units of 200 million units of clothing and 200 million units of food, where it makes the food and trades for the clothes. And Japan will be at the 250 million units of clothing, which it traded from the US, and 200 units of food that it produced itself. The US produces 400 million units of food, consumes 200, and exports 200 units of food to Japan. Japan is producing 450 million units of clothing, it consumes 250, and it exports the 200 to the US, and that's now produced domestically in each country. By increasing production and maximizing the resources and allocating the resources in each country towards the separate products, we lead towards more gains, like economies of scale, which is large scale production, where the average cost per unit is lower, and it'll be a more competitive market because we increase the scope of the markets outside of the country. So now that we've talked about why a country would be willing to trade, let's talk about now let's of another aspect of international trade where we're talking about whether a country would export or import based on two things: the price domestically and the price in the world for that product. Let's suppose that if we look at this point right here, this point C, we have our domestic supply and domestic demand, and this is our equilibrium quantity and price in the US market. But the world price, or the supply in the world and the demand in the world, has a higher price, which is designated at that point with a higher quantity and a higher price in the rest of the world. On average, the average price outside the US is higher than the price that is domestically. So what is the difference between A and B, or Q sub C, Q sub P here? The quantity supplied by suppliers are willing to supply more because the price outside the United States is higher. So, but the demand in the United States would be lower because the price outside is more expensive. So producers are willing to now, in an open economy versus a closed economy. In a closed economy, we don't look at world price. We don't. Closed economy doesn't care. But an open economy will take a look at and see that, oh, what do you know about that? I can get more money if I ship things outside the United States. So they're going to increase production and take the additional difference between QN and the difference between these two quantities right here, and the net difference is going to be exported. And these producers are willing to do more. Now, recall back to our supply and demand curve. We talked specifically about a closed economy in that suppliers are willing to supply at a certain quantity supplied at different prices, and as prices go up, they're willing to supply more. Well, if the price is higher outside than inside the country, then I'm willing to supply more and make more and then ship that. And this difference right here, if the world price is higher than the domestic price, then we will have export. And that is the quantity exported. Now, what if the world price is less than the domestic price? Again, we have our price here, and our world price here. Well, that means that the rest of the world is going to look at the US and say, hey, I can get more money if I ship my items to the US. If I have a comparative advantage, I'm willing to ship my products to US and sell it there because I can make more money because the price in the US is higher. And that is going to create an import. And the quantity imported will be the difference between what the suppliers are willing to supply and will force the price down. So domestic price will start to be forced down to meet this new supply and demand, and that quantity, this little triangle south, is not excess demand. It is demand that is being satisfied by the imported goods. The domestic suppliers are only willing to supply up to whatever price is reasonable for them in the marketplace. If the price is forced lower, then they're going to produce less. And the difference between it is going to be imported if we have an open economy. So if the world price is higher, domestic suppliers are willing to produce more and export the net difference outside. If their world price is lower than the domestic price, then the domestic suppliers are going to produce less, and the difference between the demand and supply at the lower price will be filled by imported goods. So what about if the domestic suppliers are producing less? They're losing market share. And they're losing market share because they can only produce and were willing to produce and supply a lower amount than if it was equilibrium. So we were at equilibrium before when we were closed. Now that we've opened the borders and are encouraging international trade, the domestic suppliers are saying, wait a minute, wait a minute, wait a minute, wait. What's the deal with these imported goods? Who's going to fix this? We cannot be competitive anymore. We cannot maintain our competitive advantage that we had when it was closed because now price is being in the marketplace is being forced down with these imported goods because they have a competitive advantage. And at me as a domestic producer of that same product is struggling to maintain my position and I'm losing my position because I cannot produce as much at that lower price. So what do we need? We need some help. Government. Now the government's going to get involved again to facilitate and help move the economy in this market. So they're going to get involved in the market again. And how? There are three main ways. There's a tariff, which is a tax charged on imported goods. There is an import quota, which limits the quantity of imported goods. And there is an embargo, where we eliminate the imported good completely. That's now the limitation of imports. The second one, the government could mandate a limit to the imports, or the exporting country can limit it themselves on a voluntary basis. This happens exactly what happened in the auto industry back in the 70s, when the Japanese car companies, Toyota and Honda, got involved into the US market. And the big three at the time, which was Ford, GM, and Chrysler, went to Congress and said, look what's happening. We have a situation where Japanese cars are coming in and are selling at a lower price than we can. Our market price is X, but they're selling at Y because they had a comparative advantage over US automakers, and we imported their cars here and selling at less. So they went to the government and said, what are you going to do, government, about this? And they said, okay, we're going to charge a tariff on that. So what happens with a tariff is, if we look here at this graph, here is our world price, or the price that the imports were willing to sell at in the US, right here. And this was the domestic supply and domestic demand. Now, demand is saying, hey, we're saying this is great. We got these Toyotas and these Honda cars cheaper than the Ford or the Chrysler or the GM cars. That Cadillac, that Ford, they're more expensive to me. So I'm willing to buy at this lower price that the Japanese cars are coming in at. So the demand is higher, the quantity demanded is higher. So what happens? The government comes in and says, okay, we're going to charge a tariff on these imported goods. So the price now in the domestically for the imports is no longer the lower world price, it is now the world price plus that tariff. So it pushes the price up in the marketplace. Now, you see here that the domestic supply and domestic demand, the equilibrium here is still a higher price, and so GM, Ford, and Chrysler are still charging a higher price, but we've pushed the Japanese price higher with this tariff, so it's coming closer to equilibrium, and so the quantity demanded goes down. So we go from Q1 to Q2. For our quantity demanded. The quantity supplied goes from, will go down because the Japanese automakers are not going to supply as much. And we are here at this point right here. Now, we still have domestic suppliers that are going to produce only this much because that's what they're going to be able to get for it. And domestic consumers are going to pay at this price. But what has happened is that this box right here is the difference, and that is the tax revenue. What they over and above the world price that the government's going to get. So the government benefits from this increased tariff. The domestic suppliers benefit by being able to produce a little bit more because the price is now higher in the marketplace. They have squeezed out a little bit of the import or the Japanese automakers' market share by raising the price. So the domestic auto suppliers are benefiting a little bit. The government benefits from this tax revenue just because they still allow the import. But the difference between this point here and this point here, this left triangle and this right triangle, nobody benefits anymore. There was a benefit over here at the world price when before the tariff. After the tariff, we have what's called dead weight loss. It's the same dead weight loss we talked about in when we talked about taxes. But this one is a two-tiered small rectangles that is the inefficiency and the loss to the marketplace. The quota has a similar situation, but the in an import quota that is mandated by the government, all that does is it pushes the quantity allowed to be imported down. So the T is the benefits only the foreign producers that are importing, and that's their gain from how much they are still able to import, less than at the higher amount that they were able to do, and there's still a dead weight loss, but we don't look at the dead weight loss, and we have a change in consumer surplus. Consumer surplus here was even greater if we look at this big triangle or strange triangle look, and the supplier was even less. Now the supplier has gained a little bit in S. Consumers have lost a little bit because the higher prices. Their willingness to pay is still there, but the consumers that are willing to pay less are no longer in the marketplace. So the efficiency of the market has gone down again. In an embargo, totally eliminates the foreign import, and we reduce everything back down to what was in a small closed economy. Why would a nation or a country enact either tariffs, import quotas, or even an embargo? Well, if the domestic producer or industry is needed for national defense, then the country will want to support those industries. Uh, there is the argument also that the industry may be older in another country, but in the same industry coming into the domestic country, the US in our case, as it's starting to be produced here, if we don't give that nascent industry an opportunity to grow, because its startup costs are so high, the cost to produce is high, average cost is high, and so it's they cannot produce at lower prices, so we have to push the prices up so they have an opportunity to produce. We do these trade restrictions to foster the growth of a nascent domestic industry. It also, if it's not nascent, but it is a struggling industry domestically, we also do it that way. This is the reason why in 2018, between 16 and 20, the government was discussing increases in tariffs on Chinese imported goods to support U.S. industry and companies. The other is dumping. Dumping is where a foreign country whose comparative advantages and opportunity costs are so much lower that they sacrifice margin, sacrifice price, and sacrifice profit to undercut the price, the domestic price in a foreign country by pricing their products so low that the domestic companies cannot produce at that such a low price. So they dump these low cost, low price products into the market and push out the domestic industries into bankruptcy to close up, and then they start raising the price back up because they are no longer in competition with anyone, or the competition that's there is very, very small. This happened in 2014 with the oil industry. Since 2006 and 7, there have been lots of talk about improving domestic oil or finding alternative sources of oil. There was a discussion to open Alaska to drill more oil in Alaska. But shale oil project was going through. Fracking was going on in the United States to find oil reserves in the U.S. domestically so we could reduce our dependency on OPEC and the oil in the Middle East. That industry, even though it was nascent, started to grow. There was also a project in Canada called the Oil Sands Project. There's sand in Canada that was basically shale that they were able to crush and pull oil out of it, and was becoming very successful. And the government, the Canadian government, was sponsoring that. It was very, very growing, great deal. And so it was Canada's dependence on OPEC and Middle East oil was being reduced. So that caused the prices that was so high in 2008, with at $150 a barrel, and even though by October of 2008 it dropped to 50, it's dropped even further as these companies, fracking companies, the shale oil projects in the United States, and the oil sands project in Canada were increasing or decreasing our dependency and increasing our domestic supply. So, what happened in 2014 November was that OPEC, specifically Saudi Arabia, but OPEC increased by a huge margin their domestic production of oil, and flooded the market worldwide with cheaper oil, which dropped the price even further to a point where fracking companies were still growing and were able to produce at the higher price were forced out of business. A lot of these fracking companies filed bankruptcy in 14 and 15 because of this dumping of oil into the marketplace. We know that OPEC has and the Middle East has a lower opportunity cost in producing oil. With the huge reserves of oil available in those areas, and a lot of the cost involved in extracting the oil from the ground have already been spent, it was a sacrifice on their end to dump this low cost oil in the United States. Even though dumping is illegal under a US law, no one can really prove, and no one's going to fight OPEC since we still have a dependence. Even though it was reduced at that point, we still have a level of dependency on our addiction to oil. Trade restrictions almost always provide highly visible concentrated benefits for a small group of people while imposing a widely dispersed cost that are often difficult to identify on the general citizenry. But politicians have a strong incentive to favor special interest issues, even if they conflict with economic efficiency. So, trade fallacies abound because people often fail to consider the secondary effects of trade. Trade restrictions that limit imports save jobs for Americans. This view is false because if foreigners sell less to us, they will have fewer dollars that will buy US goods. Thus, the restraint on imports also restrain exports at the same time. It's a converse or a mirror image. We restrict the trade or we put tariffs on imported goods, then the other country will do tariffs on our exported goods. So saving the jobs by putting a restriction on trade also loses the job when the domestic company cannot export no longer to that other country. So, as a result of trade restrictions, fewer Americans are employed in areas where we have a comparative advantage. Free trade with low wage countries such as Mexico and China will reduce the wages in America. The key to this issue is how will U.S. resources be used? If a low cost wage country can supply a good cheaper than we can produce it, then we gain by purchasing the goods at a cheaper price and using its resources to produce it. So we are not expending our resources to produce the same good, which is a higher opportunity cost for us. So continuing on our discussion, we're going to further on talk about international trade and international finance and the foreign exchange market, which is part of the circular flow of the economy in chapter 19. So the foreign exchange market is the exchange of money between different countries. So the exchange rate enables people in one country to translate the prices of a foreign good into units of their own currency. If Thailand sells rice in Great Britain, the Britons are going to pay GBP, or Great British Pound sterling, for that rice. And that pound sterling is what's going to be sent to Thailand. Now, the Thai producer of rice is not going to be able to do anything in Thailand with a pound because Thai people use the baht, B-H-A-T, baht. The baht is the currency in Thailand. So they need to take the pound and convert it to a baht to understand really what is the value, the nominal value of that traded good, that good sold in Great Britain. And the price in Great Britain is based on the exchange of the baht as well. So if it cost, if let's say the exchange rate between a pound and the baht is 40 baht to a pound, and the price in England for a pound of rice is 10 pounds. So if the price that you're able to sell it in England is 10 pounds, you're going to receive 400 baht for that pound. And so trade goes that along. Now, the price in Britain doesn't change from 10 pounds, but the exchange rate changes so that the baht is now 20 baht to a pound versus 40. So if you sell your pound of rice in Britain, you're going to get 10 pounds, but you only get 200 baht for that versus 400 baht that you were getting before when the exchange was different. In that case, the baht had appreciated against the pound, and that caused a reduction in the net profit from the or net gain from that exchange. So when the baht appreciated or when the pound depreciated against the baht, the producer gets less. So he's not willing to send anything to England because he's not getting as much. He might as well sell it at home and get whatever price he's getting domestically. But from the perspective of the Britain, the price did not change. So they're going to see less rice imported. So there's going to be excess demand or a shortage of rice in in Britain, of Thai rice. Now so an exchange rate also facilitates the flow of money between these countries. If the exchange between the baht and the pound was 20, and when the producer had sold a pound in England, in Britain, Scotland, Wales, England, and received that 200, I'm sorry, received that 10 pounds, that is actually, from the Thai producer's perspective, they actually own an asset of England. of Britain. That pound, that 10 pounds, is a claim against England. And they'd rather they can hold on to it, but the only reason they would hold on to that 10 pounds is when it's most beneficial for them to exchange at a higher rate. So a depreciation of the currency will facilitate more inflows into the country because it's cheaper. So there are two types of exchange rates that are mandated. There's called the flexible or floating exchange rate, and then there's the fixed exchange rate. A floating exchange rate is based on the marketplace, the foreign exchange marketplace, and a fixed is pinned by the central bank that the value of the currency is going to equal a certain amount. And that is a fixed amount, fixed. So the demand for with a fixed, meaning that the with a fixed rate, that means that the central bank will buy all the domestic currency at that rate, unlimited, quote unquote unlimited, but only at that domestic rate. So arbitrage happens where you can get, if you can buy outside of the market or outside of the central bank, if you can buy that at a lower rate and you can benefit from the fixed rate that the government or the central bank is willing to pay. So let's look at this foreign exchange market equilibrium based on the pound versus the dollar. So here we have equilibrium at this point where the demand for pounds is equilibrium to $1.50 US. So suppliers of pounds are willing to sell it at $1.50. Demanders are willing to buy it at $1.50. We have excess supply if the exchange rate is higher than that, and we have an excess demand if it's lower than that. A higher price leads to excess supply, so there will be a depreciation. So that will lower that rate back down to the $1.50 equilibrium. If the rate is too low, then the dollar value or the value will increase. So why do they change? One is a growth of income relative to the trading partners that stimulate imports relative to exports. The rate of inflation in one's trading in one versus one country versus another. Another very important one is the real interest rate relative to the world interest rate It's similar to what we talked about in chapter 18 with world prices. We have world interest rates. If the interest rate, the real interest rate, which is interest minus inflation, is lower than the world, then there will be more investment. So that would be a net inflow of cash into the country because of the lower real interest rate. I'm sorry, reverse that. There will be a larger outflow if the interest rates are higher outside the country than inside the country. So if domestic real interest rates are higher, then there will be a net inflow of cash into the country. If it's a lower interest rate, then there'll be an outflow. If there is a lower domestic price for a product, there'll be more inflow of products and there'll be an increase in imports. If there is a lower domestic real interest rate, there will be an outflow of money and cash from the country. So investment outside would be more attractive. So other things held fixed, ceteris paribus. If the income increases in the United States, then U.S. imports of foreign goods and services will grow. The increase in imports would increase the demand for GBP, or Great British Pound, in the foreign exchange, causing the dollar price of the pound to increase. If it's a flexible interest rate, then what would happen is the supply will decrease. And so there is going to be a positive shift in demand with the increased demand for pounds. That raises the price, and there'll be a decrease in the supply. Both forces will cause the dollar to depreciate or the British pound to appreciate against the dollar. So slower growth rates, a lower inflation rate, increase in the real interest rates, relative to world interest rates. These are what will cause the currency to appreciate. I talked about the flexible rates, fixed rate, and pegged exchange rates. A fixed rate is where the central bank conducts monetary policy that influences the value of the unified currency relative to world currency. The linkage may be either through the use of the same currency or through a currency board that agrees to trade the currency at a fixed rate. It makes it more difficult for that country to conduct monetary policy if they're fixing it at a particular rate. A system where a country commits using a monetary and fiscal policy that maintains a particular rate of domestic currency at a fixed rate or within a narrow band, that's a pegged exchange rate. This allows a continued monetary policy because there is variation in the exchange. A nation can either follow an independent monetary policy or allow the exchange rate to fluctuate. Under a pure flexible exchange rate, the foreign exchange market will bring the quantity demanded of the quantity supplied into balance. As a result, it will always bring the exchange rate into equilibrium.